Hello everyone, this is Anshul Singhi. My company for the Equity Research Initiative is NTPC. We start with the fundamental analysis using the top down approach, viewing the basic economic indicators like GDP, inflation rate in comparison to the BRICS nations. Then we move on to the Indian power sector analysis. India is the fourth largest consumer of oil and a per capita consumption of 717 kilowatt hour of electricity. India has 55.3% rural electrification with 100% FDI in power sector. Looking into few of NTPC's competition. NHPC and Power Grid Corporation of India Limited are from the public sector. Tata and Reliance Group from the private sector. Now comes the company analysis. NTPC has a capacity of 41,000 megawatts and employs 25,000 people. Its net worth is 80,000 crores and annual capital expenditure of 20,000 crores. To analyze NTPC intensively, we employ SWOT analysis and Porter's five forces model. Largest market share and highest capital expenditure are NTPC's strengths. Depleting coal and government intervention add to the weaknesses of NTPC. India's ever expanding power needs and huge demand supply gap are future opportunities, but involvement of private players like Tata and Reliance Group can be threats. Porter's five forces model. Threat of entry is low because of high government regulations and capital requirements. Alternate and renewable sources of energy are threats as substitute. Bargaining power of supplier is high in case of NTPC due to high cost of equipment and services and high import cost of coal. Competitive rivalry is healthy but irrelevant because of the ever increasing demand of power. This is the fundamental analysis. Moving on to the ratio analysis. This is the latest snapshot of NTPC with the stock price of 147.25, a 52-week high-low ranging from 172.7 to 122.65. NTPC has had a 5-year dividend growth of 10.44%. There are some of the important financial ratios. Increasing operating profit margins tell us that the profits have been rising with the total sales for the past 3 years. The EBITDA margin is increasing, which suggests a fall in the operating expenses. The asset turnover ratio has been constant, suggesting stable nature of the growth for the past couple of years. Now we compare NTPC's financial ratios to a few of its competitors. A higher return on capital employed suggests efficient use of capital. Public sector companies have a higher return on net worth compared to the private sector, suggesting the company is earning more money on less investment. A current ratio greater than 1 is a positive sign. In general, a high PE suggests investors are expecting higher earnings growth in the future compared to with the lower PE. This is the ratio analysis part. Now the final leg, valuation. We use discounted cash flow model to compute the final valuation of the company. Using dividend discount model, the intrinsic value of the stock was 193.44 rupees with the expected growth rate of 9%. Using dividend discount model as a sole criteria, I recommend a buy. Upon calculating the free cash flow to firms, we get a negative value suggesting an expansion plan. The intrinsic value of the stock using FCFE is 209.47 rupees with a growth rate of 10.63%. Using FCFE as a sole criteria, I recommend a buy. Thank you for viewing this.